Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, great to talk with you.
Mike, crude oil nearing the $72 mark. Is this going to continue higher?
Well, historically, oil tends to actually trade seasonally into basically the end of July and then kind of slow down or even have a small pullback, and then resume the big seasonal uptrend around the fall. It could do that seasonal pattern. But one thing about oil that's important for everyone to keep in mind is that last year we saw what was essentially a secular bottom in the price of oil and other commodities too. If you can recall, oil futures actually went negative for a couple of days in the spring of 2020, something that it had never done before, but that happened. But that's, you can't go lower than that. But the importance of this is that commodities as an asset class had been in a bear market from roughly 2012 to last year in the spring. So I think today's move up in oil should be seen in that light, meaning that if there is any pause or pullback in the price of oil, it's really just going to be a buying opportunity. And I believe that oil stocks and energy stocks are among the best investments people can make now in the markets. Yes, they have gone up a lot in the past 6 months. Exxon, for example, touched right below 30 in November. It's now trading above 62. That's a 100% gain. And when something goes up 100%, it often does consolidate, go sideways for a period of time. So that can happen. But as far as the long run goes, I think these are among some of the best places to put money at work in the markets.
Should people be looking at stocks that pay dividends right now? So you get money whether the stock is up or down a bit?
Well, I think so. And, I try to focus on buying stocks that do pay dividends. And one reason for it is when you can buy a stock that can pay and maintain the dividend or even increase it, you're buying a company that has good earnings, is able to grow those earnings, and there's stability there. And they're doing that by providing a service or doing something in the real world that's productive. And I think that helps you avoid getting stuck into stuff that's pure speculation that may not have much real value. I consider some of these collectible crypto coins as the opposite of buying a good dividend-paying stock. That's not to say, there's not room to own some stocks that don't pay dividends. I have some of my stocks that I own are very speculative, small cap stocks, but the bulk of my money is in stocks that pay dividends. And in the long run, statistics show that dividends help you boost your returns, because when you do have that period of sideways activity in individual stocks or sectors, those dividend payments help. So they do help out in the long run, and they can be considered to be income, especially now when we live in a world where bonds basically yield less than the rate of inflation.
With bonds paying so little, is there going to be new life in it if the stock market corrects or stays the same?
Well, I'm afraid the opposite is actually what will eventually happen. If you can recall, last year when the stock market basically crashed when the virus situation began, bonds went down with the stock market. The corporate bond market actually locked up. Some of the ETFs diverged away from their net asset value, and the Federal Reserve had to intervene and begin massive quantitative easing bond buying operations. And in the fall of 2018, when the S&P 500 fell about 20%, the corporate bond ETFs and junk bond ETFs also declined. They did the same thing in 2015, the time before that, where there was a stock market correction. So I think the bond market, because it's such a bubble and interest rates are so low, as a result, is prone to pull back with the stock market when it pulls back. So I think that's what will happen again. The thing is, I don't know when that's really going to start. It could be this fall, or it could be next year. Right now, the market's kind of drifting. Volatility is shrinking, and I think that's something that is likely to continue. And I can't really predict when it's going to end. I just know it will at some point. I kind of have to just watch things week by week, and that's why it's kind of good to be able to talk with you twice a month or so. So I'll be able to hopefully see when this changes. But I think what people need to keep in mind is we look at the market every day. We see these day-to-day gyrations. The media and anyone who comments on the market has to kind of talk about and try to make sense of this daily gyration. But it's the big picture which is always the most important thing. I talked about that with commodities and oil now being in what's essentially a long-term bull market that started a year ago. But when it comes to the stock market, what we saw last year was record volatility when it crashed and then rallied back up. I believe that was the sharpest, biggest rally in that short amount of time ever for the U.S. stock market. That represents extreme volatility. All volatility means is the rate that prices are moving up or down. So it was extreme, crashing then rallying, and so to speak. And when you have extreme volatility, what tends to happen is you'll have a period of time in which volatility shrinks. And that's really what is now happening in the S&P 500 and the Dow, even the NASDAQ. So that's a process that can continue for several months, and substantial market declines or corrections really bring with them an increase in volatility. That's what causes the VIX, which is a psychological measure of volatility, to get above 30. And now the VIX is below 20, seemingly heading perhaps below 15. So I think this sort of process of low volatility is going to continue at least into the end of July. It's possible that could be the end point, but if not, we'll be having to look to past Labor Day. That's the situation we'll have to try to gauge towards the end of next month.
Are we always near the height of speculation when all of a sudden baseball trading cards and now these non-fungible tokens have become hot, where before, hey, that's a nice baseball card that's worth $50, now all of a sudden it's worth $5,000?
Oh, for sure. I had no idea that, baseball cards are red hot till a year ago, and someone was sending me messages about it. I thought they were crazy, but then I looked into it. No, it's really happening. But that NFT virtual art market imploded when Bitcoin went down. So there's these pockets now, whereas I would say the overall market's seeing less volatility. We're seeing pockets of extreme speculation, I guess, from people looking for volatility, because they're getting bored of the S&P 500 and the Dow, and even gold is trading less volatile now that for the moment, in a range between 1850 and 1925 or so, after having gone up over 200 points, since making a double bottom in March. So people want action, and, Bitcoin is something that provided that for them, on the way up to 60,000, then it crashed, but it's prone to big 5%, swings, up or down in any given day. So it's attracting sort of these people. Not everyone is like this, but there's an element of people in the markets that are really trying to chase price activity. They're not getting it in the S&P 500 or Facebook or Apple and so forth. And it's crypto that's providing it for them, but so are things at the moment, such as AMC Entertainment Holdings, which went from $10 6 weeks ago to touching 70 briefly the other week and coming off that level. So that action drove so much buying into it that it became one of the top 5 most widely owned stocks on Robinhood. In the Bitcoin thing too, something like 7 out of 10 Robinhood traders traded Bitcoin in the first quarter, when it was like 0.2. We're doing that in the fourth quarter. So that's kind of where we are. I'm not on top of what is going on at the moment with baseball cards, but I do know that NFT market fell apart.
We'll have more with Mike Swanson right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, is gold something you should look at if the markets are looking a little wobbly near the top?
Yeah, for sure. And I think gold provides an important function now for anyone who's trying to diversify and not just protect what they have, but make money over the next several years. Because I think you mentioned the bond market. I think at some point we're going to, at the moment, it's kind of funny, these narratives shift. At the moment, the narrative is we got this inflation, which we do, obviously, and maybe the Fed's going to have to raise rates sooner than that has been predicted. They'd be raising rates in 2023. Now, perhaps they'll do it a year from now, before 2023, or they might have to cut back on their bond buying operations because of all this inflation. But they're not going to make any meaningful changes when they meet this week. And if we think back to a year ago, there was a different narrative that if the economy didn't pick up fast enough, or the virus didn't go away, or the stock market fell, the Fed might start yield control, which would be basically rapidly increasing quantitative easing operations to be even more dovish, but buying bonds all across the board to try to infect, freeze, and lock down all interest rates across the yield curve. Well, I would assert that the narrative of the moment that they may pare back, be less dovish, start looking for interest rate hikes. That narrative will be gone because I think the next big narrative that's going to affect gold and everything will be yield control again. So I believe what will happen is at some point there will be a 15 or 20% decline in the S&P 500, perhaps this fall, perhaps in the second half of next year, whenever. it does happen, and one will happen again in the future at some point, that will cause bonds to go down, the corporate bonds in particular, and the Fed will announce yield control to prop up the bond market, and that will make it obvious to everybody that this inflation story isn't transitory, that we're really the actions of the moment and in the future with the Fed are much more radical than people perceive, and it's going to weaken the dollar even more than it's already fallen, and gold will be something that a lot of people flee into to protect the value of their money when the bond market obviously is not going to be able to do that at all. It's really not doing it now when bond yields are less than the rate of inflation, but it'll be obvious to everyone. So I think gold is going to be one of the biggest stories of the rest of this decade, even if it's really only the ultra rich and a unique segment of investors that are participating in it now that kind of specialize in it, despite the fact that since, gold stocks when they go up provide great value, in the GDX gold stock ETF, it went from 31 to 40, from March to May, and it's pulling back close to its 50-day moving average. The technical indicators such as the daily stochastics are oversold to generate, hey, this is actually a good time to buy the dip. So I think this is a good time to buy the dip on precious metals, mining stocks, and so forth, even though still, most people, in the United States at least, are asleep on it.
Commodities like copper and steel, are they going to remain hot?
Oh, I think so. I think we're in a long-term commodity bull market, although at the moment, we are, besides oil, we are seeing a pause in most commodities. I mean, gold, I've already mentioned, got overbought by rallying over 200 points. It's working that off by dipping a little bit, going sideways. But that's the same story with copper. Copper prices were at 240 in the futures market a year ago, and they rallied all the way up to 480 without really any pullback at all. And now they're kind of drifting. They hit the 50-day moving average. Copper mining stocks, such as Rio Tinto, hit 95 in May. Now it's just above 85. So it's consolidating. It's going sideways. I think it's a good time to buy stocks like that. I actually own, Rio Tinto since I'm mentioning it. But, it doesn't mean I'm expecting it to go to 120 in 4 weeks. But I think it's a good buy opportunity. It'll get to 120 maybe by the end of the year. But the way to buy in a bull market, there's two ways to buy stocks. One is to try to chase things, which is what a segment of traders do. Whatever goes up the most, they try to jump onto. Very difficult, especially when what is going up the most are junk cryptocurrencies at one time, or weird stocks like GameStop or now AMC, which then top out. And then when they do peak, collapse. AMC jumped from, 10 to 500 and went below 50. That's not the kind of things I want to ride, but, nimble people that are really experts at playing volatility, they can do it. But the other way to buy is easier, and that is to buy on dips in periods of consolidation within bull markets. And it becomes difficult if you try to do that by going on full margin or taking giant risks. It's easy, though, if you say, okay, I've got an investment account, I'm going to devote 10% of my money into, let's say, commodities, or gold, or several precious metals, and then when it dips, then I'll add a little bit. But I'm not going to go on margin, because then you get shaken out. But if you put 10% or 20% of your money or some sort of allocation you can feel comfortable with to hold, then you don't get shaken out. And when the dividends are coming and paid, you make money without doing anything, during this period of consolidation in something like, let's say Rio Tinto. So that's how I try to navigate the markets. The other trick to it, though, is to focus on the sectors that are outperforming the S&P 500 and the Dow. And, you asked about energy stocks earlier, and that is one of the top performing sectors year to date. The XLE ETF will open the year at 36. It's now trading at 56. That's a return of 55%. That's an incredible return. At the same time, the ARC ETF is down year to date, roughly 12%. And I mentioned that ETF because so many of the popular fad stocks that make up the top 100 list in Robinhood are owned by that ETF. Stocks such as, let's say, Virgin Galactic Holdings, space. That's the type of stock that is volatile. So when it goes up, people, the type of people like to chase whatever is up the most in a given day, they jump on board. And on space, it was at 22.50 on New Year's, ran up to 60, and then collapsed down to 15. Well, on the way up, that's fun, but you got to get out. You got to know how to trade, and it's tricky to trade like that. If you don't get out in time, then you're in something that crashes. Rockets go up, rockets go down, and that's just the way these stocks move. But
the last 4 Elon Musk rockets after landing have all blown up.
Wow!
The last
I didn't
4.
know that.
The last 4 SpaceX's. One waited 8 minutes before it blew up after landing, but it still blew up.
I believe it. It's crazy. But Tesla's another example of all this too, because, Tesla became one of the most popular stocks. It's actually on the Robinhood list, number one. The most owned stock is still Tesla. And it became that because it went up for years and is very volatile. But now it's peaked out, and it's drifting. And, it hit a high of 950, and now it's at 600. So we're talking about a loss of almost 40%, like 37% or so, since February. And the thing about it, it's like, I read 2 stories this week that it's like you mentioned the rockets, making a disaster. Well, the cars can be a disaster too. 2 funny stories. One, I'll just tell one because of time here, but there was a Tesla car in China that malfunctioned. A Chinese fellow, was going to the store, and he pulled in to the parking lot, and the car malfunctioned and wouldn't let him open the door. The computer malfunctioned, locked him in. So he was trapped in that car, just like a dog. You hear these stories every once in a while about how people leave a dog in the car and the dog has heat stroke. Well, he was trapped just like a dog and suffered for 30 minutes in the heat, almost died from it. And Tesla came out on someone in the company on Chinese television and apologized for what happened. It's a story that's not made CNBC or the United States media, for that matter. I don't know why, but it happened. So these cars, are not like the safest things in the world. Many, there's stories of them catching on fire. And then I read a story this morning on Axios saying that electric vehicles on the highway can actually cause accidents. This person talked about they rented an electric vehicle car, drove down the highway, and the car reacted to someone pulling in the lane that they were in by slowing down from 65 miles an hour to 45 miles when everyone else on the highway was going over 60. And it scared the guy to death because he thought, it's an easy way to cause an accident. If you're going down a major highway and you see someone all of a sudden decelerate that rapidly, that's dangerous. So this sort of technology is not something I want to be a part of. I don't want to get one of these cars. I don't ever, much less buy one. And to top it off, Musk has opened up his tunnel in Las Vegas this year that was, going to have Tesla cars and automated things in it, and it turns out they're using human drivers. So it's a lot of hype, and I think this is a stock that anyone that owns it, now I've mentioned it in going on and on about it because so many people do, I think a good trade to make is short Tesla, which I'm not. I've tried to short it. I can't get the shares because it's just, I guess the broker doesn't want to give it to me because it's so volatile. But short or sell Tesla and go long gold and see what happens in the next 5 years. Be much happier going long gold.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com, and we'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.